Good morning, everyone, and welcome to our panel discussion on alternative risk transfer, rethinking how corporates manage and participate in risk. I will ask, as we start off, my panel participants to introduce themselves. I will start to my extreme left with Victor.
My name is Victor Shoniwa. I'm the head of the actuarial department at Makshua.
Good morning, everyone. I'm Zanile Mswela. I'm the account executive for risk financing and cell captive transfer at Makshua.
Good morning, everyone. My name is Molly Nduna. I'm a technical broker in the risk financing and cell captive management department.
Hi, guys. Langa Sugoti, an account executive in our corporate and global markets division.
In today's evolving risk landscape, with rising premiums, limited insurance capacity, and increased volatility, many organizations are exploring innovative solutions beyond traditional insurance. Alternative risk transfer, which for the purposes of this panel discussion this morning we shall refer to as ART, has become a powerful tool for companies seeking more control, flexibility, and cost efficiency in managing their risks. To help us unpack these concepts and share practical insights, we're joined by an exceptional panel of experts, each bringing unique perspectives from their area of expertise. Let's dive in by laying the groundwork for our conversation. Zanele, let's begin with the basics to set the scene. Could you perhaps help us understand what exactly we mean by risk participation and how this concept fits into the broader world of corporate risk management?
Okay, certainly, Nono, and thank you for the opportunity. So maybe let's just delve into the broader aspect of risk management for entities and corporates. If we look at risk management, there's basically four main ways that an entity can choose to deal with risk. Firstly, an entity can choose to just avoid the risk altogether. We're not participating in this area, so we are not going to be exposed to any risk that can attach from it. Secondly, an entity can choose to mitigate the risk. This is finding ways in which they can reduce the likelihood of the risk materializing. Thirdly, there's risk transfer, which is your insurance mechanisms, your reinsurance. So that's basically paying away a premium for someone else to carry the burden in the eventuality that a risk materializes. And lastly, which is why we're going to speak about mostly today, is risk retention. So risk retention is now when an organization or an entity makes a deliberate move to actually retain the risk within themselves by either self-insuring or having a deductible structure or adopting any type of alternative risk transfer mechanism to be able to carry the risk themselves.
So perhaps as a follow-up to this question, when a company is considering participating in risk, what are some of the key factors that the company should evaluate before taking that step?
Okay, interesting question. What we get really mostly from most of our clients is, first of all, if you are having an insurance premium payment that is in the near the regions of the tens of millions, it's obviously going to be a grudge purchase. And you might strategically want to start thinking to say, as a strategy, if I'm paying away these tens and tens of millions year in, year out, I'm not really getting a lot of claims. The insurer is paying maybe 30% claims every year. It starts to become a pain point to say, how are we paying this much away? So first of all, it could be a deliberate move in terms of having a risk management structure in-house that's going to be able to consume and absorb some of this premium pay away. And this is based on maybe knowing the risk and the risk environment, being mature as well as an entity. We see it a lot in our very big corporates, in our mega corporates and our SOEs, where they now have a real track record of how their risk typically behaves. So it becomes easier to say, I can actually now put some skin in the game and have some infrastructure within that's going to be able to make me manage my risk. Secondly, this risk participation is mostly data-driven. If you have the data and you have the maturity in terms of in the market, you have the maturity and you have the data to support you to be able to model how your risk is going to behave in the future, that can inform whether or not you are ripe to participate in the risk. And lastly, if you have aspirations of having cost efficiency and also capital, to be able to optimize your capital a bit better as a corporate. So capital optimization is also another reason that you would want to look at and say, are we doing enough? Because instead of paying away this big chunk of money, if we actually house it within and with the help of the services that we actually offer here at MacSure, would we be able to optimize our capital a bit better as an entity and also to improve our internal risk management?
And perhaps tell us, from a structural perspective, what are the main forms or mechanisms available to large corporates to transfer or to share the risk effectively?
Okay, so we cannot actually have a finite number of alternative risk transfer mechanisms that a company can opt into because each corporate is different. But what we have structured mostly, which is mostly like an entry level, which can provide a level of certainty in terms of how it's structured and how, ease into access to it. We have your deductible structures that can be done. We have your rent-to-sell captives, which are alternately also referred to as your contingency funding policies. And we have your first-party sell captives. Those are the main three that we have been putting together quite a lot amongst the other bespoke types of alternative risk transfer that we put together.
Thank you, Zanele. I think that gives us quite a solid foundation. Molly, let's turn to one of the most talked about art structures, captives. Could you please explain what a sell captive is and how it differs from a rent-to-sell captive?
Okay, thank you, Nono. Thank you, Zanele, for unlocking the concept of risk participation. So let me take a step further to explain how we practically implement the concept of risk participation through the structures of rent-to-sell and a sell captive. Like Nono mentioned earlier, we are currently seeing a challenge across Africa where there's limited insurance capacity, the premiums are rising, and even the insurers are now more focused on developed markets. So from there now we see that there's a need for self-structured insurance where rent-to-sell and sell captives come in. So rent-to-sell and sell captives, these are mechanisms that are regulated and practical to allow corporates to write their own risks, to participate directly in their own risks, to build capacity, to retain profits, and even have greater control over their own funds, how their insurance funds are used. Yeah. So yes, for many corporates, we know the sound of this concept of self-insuring or participating in your own risk sounds technical or highly complex, but it's actually quite initiative when we talk of it in everyday terms. So I'll just give us a simple analog where I have to walk you through the concept to make it easy. Let's imagine in this room we are talking about a large housing complex. So we'll take a sell captive as a large secure complex, our complex where we stay. So the complex, we know the complex is owned and managed by the board corporate. So the board corporate ensures that the complex meets the regulatory requirements, maintain the common property, and enforces rules that ensure everybody is kept safe and compliant. So in the insurance world, the board corporate becomes the licensed sell captive insurer. This is the entity that holds the license and ensures compliance with the regulator, and it provides the capital framework to allow this structure to become viable. So in that complex, we know there are apartments or units. So each unit is ring-fenced. That is, whatever happens in the next door doesn't affect you. Whatever happens in another unit doesn't affect the other unit. So this is the same way in the cell. Whatever happens in one cell doesn't affect the other. So we are saying you can have your claims, your profits, your reserves, and they stay within your cell. In this concept of rent a cell and a cell captive, you can either rent a unit in an apartment, in a complex. So when you are renting a unit, you are renting a cell. When you are owning a unit, you are owning a cell captive. You have a cell captive. And both the structures allow the corporates to retain their profits, to self-insure part of their risks, and also have access to the reinsurance. Just the difference is the ownership and the capital commitments.
Thank you for bringing it home, Molly. So building on that, what would you say are the main differences between these two models, both in structure and in the strategic advantages that they offer specifically to corporates?
Okay, so we'll start with the rendered cell. So this concept is ideal for corporates that want to have their own risk management function, but without committing to large amounts of capital upfront. So here is what happens. The insurer allocates capital to insure your risks as a corporate. So there's no additional funding required from you other than your normal insurance spend. Then secondly, you determine the premiums that you contribute into the contingent funds, like Zanele said. So when you determine the premium that you contribute, that builds the capacity that will determine your cover limit. Then thirdly, those premiums that are collected are not just going to sit in the fund, they're going to be invested. And when they are invested, you get the investment returns, investment income, and also the underwriting profits that stay within your cell. Then another advantage is that this setup of renting a cell is very fast, typically 4 to 6 weeks. We can set it up for you here at Maxshaw. And also your claims are settled directly from your fund. And let's say we have claims, the claims are less than what you have in the fund, which means you have a surplus. That surplus is rolled over. Okay. And you also have access to the reinsurance market. Whatever the direct insurers are enjoying as the wholesale reinsurance rates, you also have to enjoy that. You also get to enjoy that. And another benefit is that the management fee is very small. Of course, there's a management fee because the cell captive insurer needs to cater for the licenses, the regulator, and the reporting obligations. Then lastly, so maybe in short, we can just say, as a render cell captive, you get to enjoy all the benefits of a cell captive, but without a capital burden. Now for the cell captive, it's not for the big guys. If you're a large corporate, why not go cell captive? Because now, in this case, it's ideal because you are owning your own cell captive. It's like buying your own unit. So when you buy your own unit, of course, you fund it, you own it, you enjoy the benefits fully of this unit. So now what happens is that you inject the capital. The capital will be calculated by the insurer that you pay upfront. And of course, the capital is yours because you are the cell holder. So you inject the capital to make sure you meet your solvency requirements. After injecting the capital, you enjoy all the benefits of a cell captive. There's some benefits that we have mentioned already. And you also have, and on management fee, another advantage compared to the render cell. In this case now, the management fee is relatively smaller because this is your capital. It's not the insurer's capital. When you own a cell or you render a cell, you're not just buying insurance, but you are building your insurance capability that will help you to have you can build up your reserves, you can facilitate to pay your losses in the future, and even have the resilience for catastrophic losses. Thank you.
Why not go cell captive? Yes. Molly asks. Seems like quite a viable and profitable route. So now that's very clear. Once a company adopts an art strategy, the question becomes, how do they manage these new types of risks that come with it? Let's move on to Victor. From your experience, how should art clients effectively manage the risks associated with these alternative structures?
Oh, thank you so much, Nono. So what happens is, in first instance, what comes to mind is now it's our baby. It's now my insurance company. So we can do whatever we want. There's not going to be any external underwriting. First feel is if I claim a lot, nobody's going to penalize me. But however, we are saying for you to manage that, you need to eliminate that moral hazard. So we still need to determine some level of excess. So that despite the fact that this is your baby, we are saying you cannot come and milk it before you suffer from your own pocket. So we still need to go back to the departmental level and inform them that, you know what, if there is an incident, you have got to pay this out of your own pocket through excesses. So that's one way of managing small claims, and that's one way of managing moral hazard, so that people, the organization, the divisions, they don't have to just come and claim because now it's their insurance company. Additionally, there is need also to minimize or to put a cap on the losses that can be incurred from the occurrence of a single incident from one exposure unit. So we need to introduce a stop loss, but on one exposure unit. So once there is a claim that goes above a certain limit, we need to go and reinsure that so that the reinsurer can come to our rescue. Additionally, you would find that maybe there may be claims that may occur and they are within that limit, but on an aggregate, they are harmful to the organization. They may drain up the funds. So we equally need to go and secure reinsurance for stop loss, but in this instance, it's now aggregate stop loss. So essentially, yeah, those are the main forms of risk management that the company may need to employ, including a robust EMR, which is the enterprise risk management. So to ensure that even the divisions, they actually know that we need to cut costs right from our operations. Mm-hmm. So essentially, I think, yeah, that is how they can implement risk management.
So Victor, just take us through what is the role of actuarial work in this setup? How does your team support art structures through modeling, pricing, and performance evaluation?
Okay, another good question there, Nono. You see, what happens is most decisions in life and in the corporate world, they are mainly made they are emotionally driven. Mm-hmm. So most of them are not even rational. You'll be surprised how many people address wants instead of needs. Mm-hmm. So we come in as actuaries because there is need to inject premium, like what my colleague Molly said. There's need to inject premiums into the fund. So how then do you determine the appropriate amount of premium? Okay, previously the traditional route, one would go to an insurer will calculate the risk and tell you. Yeah. But now it's your insurer. It's not now your insurance company. So who is going to calculate that? Mm-hmm. We actuaries, we come in. It's not about injecting a lot of money so that you are safe. Remember, money has got an opportunity cost. You put a lot of money, you don't develop the company. Mm-hmm. You put a lot of money, then you don't get some returns from your operations. Or you put little money, then the sale can go bust. Your fund can go bust. So we as actuaries, we then come in and determine the appropriate amount of premium that you need to inject. Coupled with that, remember this is a structure that needs reinsurance, like what I've said earlier. How do you determine the attachment points from a stop loss perspective, aggregate and individual? How do you determine the attachment points for the excess? You need an actuarial analysis to do that. So in other words, we are coming in to eliminate availability bias or head mentality. Mm-hmm. People tend to say, we are setting this attachment because the market is doing that. Mm-hmm. People tend to say, I'm doing this because my neighbor is doing that. Yeah. So that's a head mentality. So when we come in as actuaries, we then eliminate that to ensure that the decisions that you implement are rational decisions. They are informed by data. they are informed by your risk appetite, they are informed by your risk capacity, and they are informed by the general environment, the business environment. So I think, yeah, in a nutshell, that is where we come in as actuaries.
Langa, despite the benefits that we've discussed, many corporates still seem quite hesitant to fully embrace art solutions. Why do you think that is?
I don't know. I think if I answered the question, if I was writing an exam, right, and I was at university, there would be something that is called, a section in economics that's called transaction cost economics. And the argument there, at least in academic theory, is that where the marginal cost of transfer, in other words, your marginal cost of your next rand spent in insurance, meets the marginal benefit of internalizing that cost. In other words, at that crossover point, that's where we need to make the decision of whether we need to internalize the cost or to keep on paying away the insurance premium. But there are also other sort of academic reasons for it. If you have a low loss frequency, you don't have a lot of claims, you probably don't want to look at an alternative risk transfer mechanism. If you don't have a strong balance sheet, because remember, we're internalizing the risk, we're carrying that from some of that risk ourselves, I should say. And if there's a catastrophe, you need your balance sheet to actually help insulate you from that loss. So if you don't have a strong balance sheet by the way of your assets, then you probably shouldn't look to the solution. And I would also say, if you don't have a high insurance spend, I think Uzanele was talking about attachment points a little bit earlier, where she was saying that if you're a company that spends per annum a couple of 100,000, this is probably not the type of solution on insurance. This is probably not the type of solution for you. But if you're starting to spend in the tens or even hundreds of millions, then absolutely it's something that you should be looking at.
And looking at the current insurance markets, particularly during hard market cycles, how can AT help corporates navigate challenges like limited capacity, higher premiums, and tighter underwriting?
I think when you talk about a hard market, right, what we need to think about is how did we get to that place? So the insurance market will respond to what has happened and what has happened historically. So when we're in the phase of a hard market, typically it means that we've seen a lot of losses. There's been catastrophes. You look at, in South Africa, we look at the riots that we see in 2021, floods in 2022, floods earlier this year in the former Transkei region of the Eastern Cape. So the insurance market will respond and say, oh my gosh, we're paying a lot of claims, we need to increase premiums and or increase deductibles. Going back to what I mentioned a little bit earlier in terms of that academic theory, it means that the marginal cost of insurance goes up, right? So in other words, the next rand spent, the cost of that from an insurance spend perspective is quite high. It means that we're actually in a situation where we're more ripe than for alternative risk transfer solutions as opposed to your sort of traditional insurance solutions. And, I think Victor very eloquently spoke about that you are your own insurer. Molly also made the example quite well a little bit earlier. It's amazing what alignment of incentives can do, because I think, Victor, you talked about how sometimes we do what we want and not what we need, but that is ostensibly just a misalignment of incentives. My incentives as your client are not the same as yours as the insurer. But when you become your own insurer, your incentives align. And what we've seen anecdotally is that when you start to set up these cell captives, you suddenly notice, because the cell is paying the claims, right? You suddenly notice, guys, why are my laptops all going missing? And there's no risk control mechanisms around that. Why do I have a lot of drivers crashing cars at 2 o'clock on a Saturday morning, right? And because in the past, my incentive was I've paid my premium, and the insurance company is going to pay my claim. Now I've got to sell, which can give me returns. I've got to manage. I've got to employ people to look after this, compliance, and all these sorts of reasons. And suddenly I'll be like, nah, man, actually, we need to get our house in order. And it creates a great alignment of incentives. And I think that's something that, that's really the sweet spot, where we all want the same thing. We're driven towards the same goals. And it's a great mechanism for creating that and making that environment happen.
So in essence, we're learning new behaviors and putting our house in order.
Yeah, you've got to do that, man. I mean, yeah, that's also, it's important, again, everything that Victor was saying, talking about your deductibles. When you don't have a deductible, you might drive your car a little bit recklessly because, at the time of an incident, you don't have to think about that potential 5,000 Rand or 7,500 Rand that you might have to pay. So again, let's align incentives from a risk management and understand what our philosophy is as a corporate, and we'll achieve a lot of great things.
Great stuff. So before we wrap up, I would like to end with a forward-looking question that each of you can respond to briefly. So I'll start with you, Langa. If you could give us one piece of advice to corporates exploring art solutions for the first time, what would it be? And I want your answer, perhaps think of it in terms of mindset, in terms of readiness, or strategic approach. What do they need to get right from the start?
Wow. Get a broker, I think is, no, but sincerely that, because a lot of what we've seen in terms of hesitance is that there's a lot of regulatory implications to the solution that you may not necessarily have the expertise that are readily available for. There are tax implications. If you were to draw down money from the fund, there are certain tax implications for that drawdown that are different to your normal income tax statement of comprehensive income implications. So I think, just get an advisor. Because, as Victor very well told us, that sometimes we're factoring in noise. Speak to an actuary, consult with an actuary, a broker who's going to help you ascertain the right levels for you, whether you are actually ripe for this sort of solution. And you can't go too much further, one step at a time, I'd say.
Molly, if you could give one piece of advice to corporates exploring art solutions for the first time, what would it be?
Okay, my advice is we at Maxshaw, what we do every day is to structure alternative risk transfer solutions for our clients. So here at Maxshaw, we say, why do you have to keep on paying others when you can manage your own risk, you can profit from it, and you can grow from it? So like I said earlier, when you are doing this, when you go the art route, you are not only just buying insurance, but you're also building your insurance capability. And that's where the real value of risk participation begins.
The very same question to you, Zanele.
Okay, I think what really should underpin risk participation, in my opinion, and also informed by what my colleagues have said, is a real intention to go deep into your enterprise risk management. Mm-hmm. It has to start from the bottom up, or else you are just building your fund to just be blown up. Okay. So if we just improve the risk management culture from what everyone does, it's something that also improves the longevity and the viability of the fund that you put up. The beauty of it is, if you're maybe working with an outfit such as ourselves, we are going to come in and conceptualize the vehicle for you. We are going to ensure, through the capacity that is sitting in our actuarial, that you are modeling and putting and setting the appropriate limits for your internal deductibles, for your excesses, for your stop losses, for your catastrophe cover appropriately. And that is not a static number, by the way. As the fund grows, the behavior of the risk grows, the recalculation of all of these things should ensue, something which is still within our outfit. in improving as well the quality of the risk. It's something that you still find in our outfit. We have our risk management department, we have risk improvements that we can recommend, and also the reinsurance that you will need behind the structure in case you have your structure structured today. In a month there's a 3 billion claim. The reinsurance that you put behind the structure is something that's also housed within the actual outfit. So essentially, it's an end-to-end, and if it is looked at, conceptualized, and calculated just right, it could be a solution for our mega corporates, our SOEs, with a very, very, very fat insurance spend currently. Cool.
And lastly to you, Victor.
Thank you so much, Nano. Yeah, I think I do agree with my colleagues, so I will echo the same sentiment as them. I know, of course, we may argue that self-praise is not a recommendation, but I think just come to make sure, I think we are more placed to walk you through it.
We are indeed well positioned to set up the art solution for your corporate. Thank you to all our panelists for these insightful contributions and to our audience for being part of this important conversation. What we've had today reinforces that alternative risk transfer isn't just a technical solution. It's a strategic mindset shift. It's about corporates taking a more proactive role in understanding, owning, and innovating around their risks. As we face an increasingly complex and uncertain world, the organizations that succeed will be those that don't just insure against risk, but participate in managing and shaping it. Once again, thank you, Victor, Zanele, Molly, and Langa, and to everyone joining us today. I hope this discussion has inspired you to look at risk through a more strategic and innovative lens.
Very insightful topic. You mentioned that one of the key features that differentiates a cell captive as opposed to a rent-to-sell is that on the one hand, there's an obligation to put in some sort of capital, and then on the rent-to-sell, there isn't an obligation to put in capital, but there is some sort of risk premium then that is injected into the cell as such. Based on your experience, what would be the average capital outlay that a company would have to give out in order to get a cell captive, as opposed to maybe in comparison to the risk premium? I guess what I'm trying to get to is what would incentivize a company that has cash to go the cell captive route, the full cell captive route, as opposed to the rent-to-sell?
Oh, okay. Just to answer that part, you see, the decision is not mainly driven by cash. The decision, forgive me, the decision is mainly driven by the ability to pull together a lot of exposure units. For instance, we've got a lot of cars. So you may find that an insurance company is operating and its vehicle book has got maybe 2,000 cars. So if you have got 2,000 cars as a company, it means you can also operate an insurance company because already you've got those 2,000 cars. So it's not mainly driven by the fact that you have got a lot of cash. Then the capital requirements into the sale, they are mainly driven by the regulator. So for instance, the regulator can say, I need a minimum of 5 million. So it means if your risk is good and the actuaries determine a capital that is lower than 5 million, you still need to put aside 5 million because that's the minimum. However, if the risks are bad and your reinsurance arrangement is not optimized, it means you may need to put a lot of capital. So it all lies with the actuary. For as long as the actuary has done his calculations, issued the certificate, so it then goes to tell how much capital it is. So it's not necessarily an average thing. It's more to do with a minimum, or it's risk-based. Then the other point that I also need to highlight is With a render cell, we are not saying you're actually substituting both the cell captive and the render cell. You are still going to inject risk premium, which we say the actuaries have got to calculate and determine. The only difference is that with the render cell, you tend to be riding on somebody's license. So, but with the cell captive, it means the administration, the actuarial calculations, those costs, they still lie on a balance sheet. So it's essentially one of the main differences.
Okay, in a cell captive, you have to pay out the capital outlay or the obligated capital, but you still have to also inject the risk premium over and above that.
Yes.
And then in comparison to the renter cell, where you don't necessarily have to pay the capital or the obligated capital, but you still are obligated to inject the risk premium.
100%.
Got it. Thank you.
Mine is not a question, a comment, and Zanele has just taken my words out of my mouth. But essentially, I just wanted to stress the point that ART, one of its main benefits, is building capacity for corporates. As you would know that traditionally, or traditional insurance, being a big garage purchase, the formula is very simple. Is that for R1 that we take from you, we expect that we will pay 60% of those claims. And that's how the simple formula is. And no matter how good your risk is, you'll be influenced by the overall portfolio or market conditions, and therefore you find that you are left to the vicissitudes of the market every time you go to place your risk traditionally. So for corporates to approach this in an alternative risk transfer approach, it helps them to build capacity over the years. That in the good years, they are able to participate from the profits that insurers would have retained. And that in time, when markets are tough, they are able to, having built the capacity, not to be the price takers, but be price makers. Yes. In that way, it helps them in the buying process to help determine their fortunes over a period of time. So capacity is one of the major benefits. And I'm not going to go to most of what Zanele said.